portfolios after the budget. Aishwarya Dadich, founder and CIO at Fident Asset Management, joining in. Aishwarya, lovely chatting with you. I think I'm chatting with you after a long time. First and foremost, the recent leg of up move that we have seen in the market, although we are fairly volatile at the current juncture, do you think it has, more legs to it now that the budget is out of the way? We have the RBI policy as well tomorrow. So post the policy and after the budget, do you think we will sustain this up move?
Yeah, so obviously we saw, first of all, good morning, and my apologies, good morning to all the viewers. Saw a lot of volatility, especially in Jan, and all this event playing out both in India with budget, and then we saw what happening with the US, Trump and all that. I believe this volatility is here to stay for some more time. We have the tax bill coming today, tomorrow we have an much awaited policy. Day after tomorrow we have the election outcome, which will have an impact on Monday, more or less. So we are in, I would say, turbulent sea, and this volatility is here to stay. Only thing which really makes me more jittery about this is how the currency will play out. What we have seen with the Trump announcement and the on and off of trade war, this volatility will basically make dollar stronger, Nandita. And when that happens, this will have a repercussion impact on emerging market currencies and emerging market equities. So if I were a head on FI who is a global asset allocator, the idea is that at 4.5 or less than that, with more stability in US dollar, give more comforting position for those investors, and that money can possibly go throughout for the next 2 to 3 months into the US, impacting all of this emerging market equity as well as currencies. Good thing which has happened, in my view, which can provide some stability to this volatility in the market, is if you look at the result season so far, has not been very disappointing. And second is there is some element of both growth plus our pro-growth budget will provide the much needed impetus. So if you see the GST number recently, if you see our manufacturing PMI we hit day before yesterday, it's showing some signs of stability coming through. And the consumption-based expected growth because of budget can provide some more stability to the India macros and India earnings season. So I think it's a fight between the resilient domestic India's market, macroeconomic side, versus the upfield which is happening in the global market, all led by Trump and associated things. So let's see who will win over, but that will obviously induce more volatility into the system.
So yes, the volatility is here to stay, and as you rightly pointed out, the dollar has been strengthening, and that has been keeping the FIIs away from our markets, right? There was some bit of buying that came in day before yesterday from FIIs after 23 straight sessions of heavy selling, right? Do you think that was just a flash in the pan? Because they are also heavily shorted, right, in our system. They have reduced some of those shorts. Now I think the long short percentage terms stands at I think somewhere around 18% and 82%. So they are still heavily shorted, on the short side when it comes to the Indian market. Do you expect some of it to be covered? Would you say that the buying that we saw day before yesterday was just a precursor to a FII short covering rally? FII driven short covering rally?
Yeah, I think that data is just an oasis in a desert. I think I'm not reading too much into that positive number after a $10 billion of selling in the month of January itself. What I understand is when I look at India's valuation compared to most of the emerging market, in spite of all the decline, India is still expensive. The only country which is more expensive than India is New Zealand, or possibly US. That is which, like, a couple of names there. So what I understand, the pros and cons of how FIs are looking through, I believe the hot money part of the world, which is more, I would say, temporary in nature, possibly has gone out. But I don't expect too much of selling from here onwards. The quantum which we basically saw in January. Whatever will happen is more to do with, as I said, the strengthening of dollars and with the way US provided more better opportunity, at least from the debt perspective, not equity, for all these investors which possibly see moving money moving away from that. But if I look at from FI holding perspective, we are at like a decade low. I think we are closing to 16% or so. So there is now a very limited room. India's story is still intact. Macroeconomic indicators are still intact. We are possibly though not 8%, 6.5%, but still the fastest growing economy, large macro economy in the world. So that turnaround possibly will happen where they will go back to 17.5%. But and it might take a couple of months. So there might be a couple of months of more selling until unless we have a stability about what Trump will do, how all this trade war will play out. This and possibly at back home, how result season and the earning growth momentum looks like. Till that time, possibly FI selling can continue for at least 2 more or 3 more months before we see some stability there. And that will bring in the volatility as we were discussing last.
Okay, got your point. Of course, there are quite a few moving parts as well. We really don't know how this trade war is going to pan out from an India standpoint, and of course, we will be reacting to that as and when it plays out. But you mentioned, of course, that there has been some improvement in quarterly earnings as well, right? First 2 quarters were washout quarters, third quarter maybe a little better. But what, according to you, have been the hits and misses from whatever we've seen so far? What do you think has turned out to be a winner? Which sector? And which, according to you, has seen poor earnings and which will take some more quarters to reverse?
So basically, we are still in the process of quarterly. Today is a very heavy day with likes of SBI and ITC reporting numbers and many others. I think 75-80% of the Nifty 50 companies have already reported numbers. And when we saw that in detail, what we trying to bring the point here is the kind of pressure that we witnessed in Q2 has abated in Q3. Right. Obviously, the expectations also went down very low. So, if I look at the Nifty 50 companies which have reported numbers so far, we have expected to report a revenue year-on-year growth of 4%, where they reported almost in line to that number. So, there is no further deviation from what I would say estimations were on revenue as well as on PAT. I think the PAT growth for these companies was expected to be flattish, 1% or 2% growth year on year. And we have reported that number only. So in short, the number with which we are speaking right now, that 5% growth or 6% growth of FY25 still holds. And we don't expect there's any sharp cut in Nifty's FY26 or FY27 EPS post this quarterly result. On top of it, if you look at the sectors which have done well, I believe BFSI has stand apart. IT has supported the result season. Chemical is one sector which has come out of a surprise, and many of these companies have reported very decent number. Sector which has basically been impacted more are more close to commodities and oil and gas and metals and all that, which has actually dragged down the earnings. But BFSI is one which has been providing the much needed growth momentum given the expectations to this earnings season so far, which has not led to sharp cut in earning thus far. But chemical is something which has really at least got my interest there.
All right, chemical, poised to do well. Of course, it's with intensifying trade war between US and China. India, of course, stands to benefit. The whole China plus one theme that could, of course, play out for chemicals. But the budget gave impetus to consumption over capex this time around. Would you do the same when it comes to building a portfolio? Would you look at consumption names? Because the hopes are that urban consumption slowdown that we have seen will be countered by the tax cuts that were announced in the budget under the new tax regime. But the whole theory that the entire money will flow into consumption, some of the experts are divided on that. Money could also flow into capital market themes, which is why I think we saw a good rally coming in on capital market related stocks yesterday. How would you play consumption in that light? Do you still believe that consumption is valuation wise fairly expensive? Because traditionally consumption is expensive, right? So, based on this theory that consumption will go up, would you look at consumption, or would you say that, not really, they're still expensive?
Yeah, so what I've been hearing around after budget is it's consumption over capex. But how do I say this is I think it's consumption plus capex. So capex is definitely not going out. Obviously, the excitement about that high 20, 30, 40% growth because of the base is looking at 10% on the revised number. Obviously, the big shift which government rightly did was to induce consumer to directly start spending, which will provide us the much needed impetus for growth, which is lacking, especially in the urban side. And we will start seeing this data, especially when this number will start reflecting a couple of quarters, 2 to 3 quarters from here. But when I look at from the consumption as a sector to play, I think there are 2 points I want to bring here. First is, I don't believe that this shift, when we're talking about almost a 1 lakh crore of saving, this shift, the saving is primarily 70% of it will accrue to household income, which is between 12 lakh to 50 lakh rupees annum. And in that cases, we are not expecting that the staples will see a disproportionate spending. What we understand here at Fraternity is a large part of this saving will possibly find its way either in discretionary spending or possibly in capital market in the form of saving. Eventually, everything will go to BF banking and deposit growth will move up, but discretionary spending and possibly platform play where the financialization of saving is the thesis I believe can benefit out of it in the coming times. Now, when we come to the discretionary spending, what are the sectors which we believe should do well is possibly retail or possibly aviation or I would say hotels, apparels, even high. I would say two-wheelers, in especially automobile sector. So those are the areas which we possibly are parking our money there, in getting in cognizance of what the valuations. So auto is one, Nandita, which possibly two-wheeler auto is where valuations are comfortable and which will be a play on consumption going ahead. And second most important thing is, if you look at the last 4 years, value stock played very well, right? We saw a lot of this growth story underperforming and value because of the way government was spending and the whole narrative was changing. And I believe right now with the shift will happen toward more growth and possibly lesser on value. That tactical allocation to asset quality, also in the portfolio, is what I believe is the talk of the time. So that shift should possibly happen over the next couple of quarters.
Okay, so you said it's a consumption plus capex budget. So would you still look at capex related themes like defense, railways, or would you say that despite the correction, valuations are still elevated because they did see quite a spectacular run, right? And order books may be swelling up, but it has to trickle down to numbers as well, revenues, etc. So would you look at these capex themes as well?
So on the capex theme, what we did one webinar very recently for the annual outlook, and we said this is a year of selection, Nandita. So even in capex, there are certain areas which you have to completely ignore. So we completely ignored railway all of last year. Similarly, we ignored rail also as one of the area which we will not even look at, roads and railway. I believe this year defense is something which possibly still have a lot of cushion left, because I think this is very strategic to the country. And when you look at the operational numbers, the order book and things like that, and the kind of spending which will happen, there is still some juice left in defense stock. When coming to capex story, there are names which we believe can still provide that much needed growth, but one has to be very, very selective. You just can't spray and pray that the whole thesis will play out this calendar year. So obviously you will have to have a mix of consumption plus capex, but we will not be in that camp who will completely ignore capex as a theme. I believe that is where the alpha will be created going ahead, if you are able to identify some of those high prone growth area in capex where valuation in the last 1.5 2 months have taken a sharp beating.
All right, so it's a mix of capex and consumption. That's how your portfolio should be really constructed. But last question, really, we have the RBI policy tomorrow. We have a new governor. Your expectations and what would you be watching out for from his commentary, from his very first?
So I think this is going to be the most difficult for the new governor to come, and I think this platform, the stage is very, very intimidating for him, right? Because why I say so is normally we haven't seen rate cut happening when currency depreciate, right? And at the same time, yesterday, before that, the probability of US cutting, say, 2 rates were very, very low. Now, obviously, we saw yesterday that there was some weak data coming out of the US, and we saw the US 10-year went to almost 440, 442, and the expectations of rate cut is inching up. But back home, we possibly have a very strong risk factor of currency depreciating if we see this cut happening on our repo rate. But at the same time, it's like, if you have to see the bill balance, the risk is on the currency side. The requirement for a rate cut is obviously the slowing down of growth. And the way the RBI has infused liquidity last week, we are at, I think, almost 50, 60,000 lakh window number as of now, compared to 2.5 lakh crore of liquidity deficit before that. And we all understand that transmission doesn't happen until we have liquidity in the system. It indicates that RBI will possibly bite the bullet and cut 25 bips rate cut tomorrow to provide the much needed growth aspect. I just want to bring one data point here, that if you look at one of the emerging markets similar to India is Indonesia, which has cut rate really recently. And we haven't seen much of his currency getting depreciated. Obviously, every macroeconomic is different, just to connect the dots. So possibly the way our inflation data is looking at, and the expected inflation in the coming months looks to keep moderating, we have a very small window to cut rate in Feb to provide the much needed impetus for the slowing down of growth. So inflation is in our favor. It can help us in our growth part, but possibly currency is a worry. So it will be very interesting to watch what happens in RBI policy meet tomorrow. But short, we are expecting a 25 basis.
Yeah. Sure, it will be interesting. All eyes are on this policy, trained on the new governor as to what kind of commentary comes in, what he does, because most believe that last policy's 50 basis point CRR cut would have set the stage for a rate cut as well. But of course, we'll get to know only tomorrow. But with that, Aishwarya, I would like to thank you for taking out time and joining in and sharing your thoughts with us. Always a pleasure, and I look forward to interacting again in the future as well.
Thank you, Nandita. Thank you so much.
Thank you. But on that note, we have completely given up all of those opening gains. Under that 23,700 mark on the index. Sensex as well, 100-point cut. Even the broader end of the markets, moving down. But the advance decline ratio as of now is in favor of gainers. So 3:2, that's the NSE advanced decline ratio at the current juncture. But very quickly, I want to take you through what SBI expectations are, because numbers are expected. The stock is not doing all that well ahead of numbers. It is expected to be a good quarter, with the profit likely to surge 64% on a YY basis. Asset quality is likely to be stable, but slippages may see some bit of an increase. Healthy growth is likely in both loans and deposits, and NII, or net interest income, is expected to see a modest 6% rise. Aside of that, you also have ITC that will be reporting numbers. Net profit may slip on the back of high base. Last year, same quarter, there was some bit of tax credit. Because of that, the base is high and the profit figure may be lower. Cigarette volumes, that's the most important thing to watch out for. That is expected anywhere between 3 to 4%, and in terms of revenue, it is likely to report the highest amongst its listed peers. Revenues, in fact, may rise 11.5%, but profit, as I mentioned, could see a degrowth of 8.1% or thereabouts. Aside of that, FMCG cigarette segment, these are expected to do well. Revenue for tobacco segment may see a 7% jump. Agri and paper arms, however, could be a drag. And the other one, Trent, very quickly, want to just say that revenue here is likely to grow in double digits, and profits are also likely to jump on strong footprint additions in West Side as well as Zudio. But remember, the stock has not been doing all that well. Last year, it was the showstopper, so to say, the nifty showstopper, but this year hasn't had such a fashionable run. And the re-entry of Sheen into the Indian market, that hasn't really gone down well, and we've seen the stock reacting to expectations, or the possibility of higher competition going forward. So yes, all in all, a big day for earnings. Aside of that, you also have Britannia and Bharti Airtel. These are some of the other companies that will be reporting numbers as well. So yes, a busy day on the earnings front, but for now we are completely timed out on this edition of Opening Bell, leaving the market trading lower by 60 points or thereabouts on the Nifty. But let's see how things really pan out, because for now the advance decline ratio is tilted in favor of gainers. But with that, thanks a lot for tuning in to Opening Bell. But we will be getting you a chat on what to expect from the RBI policy this time around at 11:30 a.m. with Lata Venkatesh. Don't forget to tune in for that. And of course, post that, we'll also see you on Closing Bell. Have a great trading day and come back and join us later. Thank you.